Ever wonder if you're the only one who thinks stock market sounds less like an investment opportunity and more like a secret club, or maybe a high-stakes casino in a poorly lit basement? Most people, bless their speculative hearts, think investing is about finding that one hot stock tip. You know, the one whispered at a cocktail party or screamed by an influencer who also sells dubious fitness tea. They're constantly chasing the next big thing, buying into rumors and praying for overnight riches. It's a strategy, if you can call it that, built entirely on hope and about as reliable as a chocolate teapot. It's a recipe for financial disaster, usually served with a side of regret. At Simply Speaking About Money, we're not here to predict the future or recommend which lottery ticket to buy. We're here to talk about building real, long-term wealth, not through speculation, but through understanding probabilities. This isn't about being lucky, it's about being smart. We're going to pull back the curtain on the stock market, strip away the jargon, and show you how to actually make it work for you. So, ditch the crystal ball and buckle up. We're about to make the stock market so simple, you'll wonder why you ever bothered listening to your expert Uncle Barry. Let's start with a foundational truth. When you buy a stock, you're not just buying a ticker symbol on a screen. You're buying a tiny piece of a real company. Imagine your favorite pizza shop. Delicious, profitable, always bustling. When you buy a share of stock in a company, it's like buying a slice of that pizza shop. You now own a fractional part of its ovens, its secret sauce recipe, and its future earnings. This isn't just about owning a piece. It's about participating in its growth. And thanks to modern technology, you can literally buy that slice from your phone in seconds. No awkward conversations with the owner required. Now, owning a single slice of pizza is great. But what if that one pizza shop has a really bad month? Maybe the cheese delivery went missing, or the health inspector paid an unexpected visit. This brings us to the first core principle: diversification. It's the grown-up way of saying, don't put all your eggs in one very fragile basket. Instead of just one pizza shop, imagine owning a tiny sliver of every single reputable pizza shop in the entire city. Or better yet, every profitable business you can think of. This is where index funds, or exchange-traded funds, ETFs, come in. Think of them as a variety pack of company slices, or a massive buffet of businesses. You own a little bit of everything. So if one company, or even an entire industry, takes a nosedive, it's just a tiny ripple in your massive pool of investments. Your overall wealth stays relatively robust. It mitigates risk and ensures that a single bad day for one company doesn't ruin your entire financial year. It's boring, yes, but boring is incredibly profitable over time. The second core principle is time in the market, not timing the market. That's a crucial difference, like expecting a plant to grow overnight versus nurturing it for years. The market goes up, it goes down, it throws tantrums. These fluctuations are normal. Even that thriving pizza shop has good weeks and bad weeks. But historically, over long periods, economies grow. Companies innovate. The market tends to trend upwards, like a slow-moving, incredibly wealthy freight train. Your strategy here is patience. Don't panic and sell everything when the market decides to take a quick nap or even a brief dive. That's when you lock in losses and miss out on the inevitable recovery. Investing is a marathon, not a frantic sprint where everyone's jostling for position and occasionally tripping over their own shoelaces. Once your budget is working and you've started investing, the next step is optimization. That's where Betterment comes in. Betterment is an automated investing platform that builds and manages a diversified portfolio for you. It handles rebalancing, tax-efficient strategies, and long-term planning. so you don't have to. You don't need to time the market. You don't need to pick stocks. You just need a strategy and consistency. If you're serious about growing wealth the smart, disciplined way, check out the link in the description to get started with Betterment. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you. And finally, the magical, almost absurdly powerful principle of compound interest. It's often called the eighth wonder of the world, and for good reason. Simply put, it's money earning more money. Imagine your pizza shop not just making profits, but intelligently reinvesting those profits to open more pizza shops or buy bigger, more efficient ovens. The money your investments earn then starts earning money too, creating a snowball effect. It's not linear growth, it's exponential. This is how true financial freedom is built, quietly, steadily, year after year. It takes advantage of time and consistency, turning small beginnings into substantial endings. Now, let's talk about the allure of getting rich quick. It's tempting, isn't it? Like building a mansion overnight with a single hammer and a whole lot of optimism. You'd end up with a structurally unsound, probably lopsided disaster of a house. That's speculation. It's hoping for a miracle instead of following a proven plan. Long-term investing, on the other hand, is like hiring a skilled architect to design your dream home. You use proper blueprints, sturdy materials, and experienced builders who know what they're doing. Those skilled builders, they're your diversified index funds. The patient construction, that's your consistent contributions over time, letting compound interest do its heavy lifting. It's less exciting than swinging a hammer wildly, but you end up with a solid, beautiful home that stands the test of time. A home that doesn't collapse on you during the next market tremor. The quick-build homes might look flashy on Instagram for a minute, but they almost always fall short. Instant gratification is rarely, if ever, a financially sound strategy. So, the key takeaway here is profoundly simple. Focus on probabilities, not possibilities. We're not betting on a long shot, we're playing the odds. The probability that the global economy will continue to grow over the next 20-30 years is extremely high. The possibility that one specific stock will make you a millionaire by next Tuesday, well, you might as well buy that lottery ticket. To recap, first, embrace ownership. Buy small pieces of great companies. Second, diversify, diversify, diversify. Don't put all your eggs in one basket or even one pizza shop. Third, stay in the market for the long haul. Ignore the daily noise. And finally, let the magic of compound interest do the heavy lifting for you. Yes, wise investing isn't always glamorous. It's not the thrilling, high-octane drama you see in movies about Wall Street. It's actually pretty boring. Unlike chasing meme stocks, which often crash and burn spectacularly, long-term investing is predictable. It's reliable. It's the quiet hum of success, not the blaring sirens of a financial meltdown. It's about prioritizing a secure financial future over a fleeting dream of instant wealth. And trust me, avoiding the stress of watching your money evaporate is far more satisfying than any quick thrill. So, ditch the hype, forget the get-rich-quick fantasies, and start building real wealth through the power of probabilities. You'll thank yourself later, probably while enjoying a stress-free slice of pizza. If you want more insights into building wealth with common sense, not chaos, make sure to subscribe to Simply Speaking About Money right now. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest. because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further. Budgeting is step 1. Investing is step 2. That's where Acorns comes in. Acorns helps you start investing automatically, even with your spare change. It rounds up your everyday purchases and invests the difference into diversified portfolios built for long-term growth. You don't need thousands of dollars. You don't need to be an expert. You just need to start. When you pair smart budgeting with automatic investing, you build momentum, and momentum builds wealth. If you're ready to make your money work while you sleep, check out the link in the description to get started with Acorns Affiliate Disclosure. I may earn a commission if you sign up using my link at no extra cost to you.